Hello, this is Brian Resney, President of Resney Wealth Management, bringing you an important update about the economy and the investment markets. We're firmly into the third quarter of 2024, and the quarter's off to a decent start on the economic front. While we're seeing some current volatility in the markets, which I'll cover a little bit more in detail, we like what we see in the economy. We don't see signs of recession. We see a GDP this year growth of about 2.5%, which is good. We see the unemployment scenario, which is actually very positive, meaning people are employed. And remember, one of the things I've talked about a lot, if people are employed, meaning we're not seeing high unemployment numbers, the consumer has a job, they will continue to spend, which means, again, no immediate recession. Recessions just don't come and go. They usually are brought on by excess Fed policy and also by really unemployment numbers going up substantially. But people are employed. That's a net positive. They will continue to spend. The Fed's meeting this week, of course. They're going to make decisions, not necessarily about if they're going to raise rates in September, but I think the language is what you want to listen to. I think the economy on the inflation front has come down quite a bit, and it's really getting close to their pivot point, and I think there's a good possibility in September they'll start to reduce rates slowly, which will keep the economy hopefully at an even keel, meaning further growth. The one important thing I want to stress to every one of our clients, and we've been managing money for over 30 years. You know, if you're a client for 5 years, you're ecstatic. If you're a newer client that just hired us a month ago or a year ago, my opinion, and one of the things I discuss with every new client, you'll be ecstatic in 5 years. You may be ecstatic year one, but I don't know if year one is a year where you're down 10% because the economy has a slowdown. I don't know if year one you're up 10% or somewhere in the middle. But generally speaking, we look at an average 5 year. And if I look at the next 3 to 5 years in general, I see a growing U.S. economy, which should bode well for the overall U.S. economy stock market. And again, that could bode well for your portfolio. I want to make sure that every investor understands, especially our clients, markets do not go up every week or every month. In fact, you could have a month that you're down 5%. You could have next month down another 5% before you're up 5%. This is statistically what happens. The markets don't always go up in a straight line. We could have a 10 or 15% correction before we see the next up 15%. But what I will say is, year to date, we're very happy with the results for our clients, and we're in a good position. But again, short-term volatility is normal. Do not look at your statement every month and think, oh, I'm down this month. You're going to be down this month, and you could be down next month. The way that you accumulate wealth and make money for retirement is over a rolling 5-year time frame. So as I've always talked, and I try to educate every client, which I think our clients generally speaking are very level-headed, they understand volatility is normal and expect more of that in the second half. But with that said, if the economy keeps growing the way it's growing, if the inflation front's coming down, the Fed does start to reduce rates, we really see a vibrant U.S. economy. We're invested mainly in the U.S. We are not looking overseas at all currently, although we are looking at the markets on a research point. We're not looking to invest there. And why is that again? Because the U.S. is the strongest house. We've made a few adjustments to some of our bond positions and some of the client portfolios in order to go out a little bit more on the maturity level, and that's been right because as rates are anticipated to come down, remember, bond values can ultimately go up in value. So bonds are not always going to be in a portfolio, and they may never be in part of your portfolio, but there's times for bonds, there's times that you don't want to have bonds. An interesting comment that I heard from a client a couple weeks ago. The client said, you know what, we hired you to manage our money. And the client said to me, you're the first firm we've ever worked with that actually managed our money. We worked with some of the big firms in the past, and they said all they did is asset allocate our money, and they continuously told us we always have to own bonds for diversification. And the client realized that sometimes you don't want to own bonds, but for some reason these big Wall Street firms would always stick bonds in that client's portfolio. Folks, I'm here to tell you, the way Wall Street does it and the way a real money management firm does it is apples and oranges. As we look at all asset categories at Resney Wealth Management, there's times we own certain areas and there's times we don't. There's times assets that we own are not performing in line, but we own them for a reason. And we hope that they will outperform eventually. So remember, we look at your portfolio as a whole, we look at the economy, we do hardcore research. Our goal is that we make you financially successful over long periods of time. and that's exactly what we are good at doing. If you have any questions as a client, please give the office a call. If for any reason you have a good friend or family member who is distraught with their current firm they're using, we always appreciate your business and, of course, your referrals. Make sure you have yourself a safe and profitable day.